This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, March 25th, 2016. Euro dollar. So the euro has come back under pressure in recent trade, with the market putting in 5 consecutive sessions of negative closes and lower tops and lower lows, with the market now potentially poised for a retest of some recent support at 110.58. But while the market holds above 110.58, there is risk still for a higher low and fresh upside back towards that 2016 peak at 113.77, above which exposes 14.95 further up. Overall, the market remains quite choppy, and the broader downtrend does remain intact, so it's going to be important to pay attention to 1377 above and 1058 below. If we see a break back below 110.58, that will do a good job of strengthening the bearish outlook and accelerate declines. Sterling dollar. So cable continues to be under pressure, with this market consolidating off those recent 7-year lows at 138.36. At this point, key support comes in at 140.53. That's the low that we saw going back to the 16th of March. A break below there would do a good job of strengthening the bearish outlook, accelerating declines back down towards 138.36, which guards against critical multi-year base at 135. At this point, rallies should continue to be very well capped, while only a break back above 146.68 would compromise the bearish outlook. Dollar yen. So despite the recent bounce in dollar yen off that recent multi-month low at 110.67, the overall price action continues to favor the downside while the market holds below the 115 handle. A break back above 115 would be required to take the immediate pressure off the downside, and until then, there is still scope for additional weakness below 110.67, which could see a real acceleration of declines if we take out the critical barrier at 110. Euro Swiss. So not much going on with Euro Swiss at the moment. The market continues to consolidate over the past few months, though overall the broader recovery structure does remain intact here, and dips are very well supported in favor of what could be the next upside extension beyond the recent multi-month high at 112 and towards the 115 area further up. At this point, only back below 107.15 would compromise that constructive outlook. Aussie dollar. So Aussie has seen some setbacks in recent trade after the market rallied out to a fresh 2016 high at 76.81, but the market is still supported and remains supported so long as it holds above that previous resistance at 73.85, which could open the door for fresh upside eventually towards 78.50, that next key medium-term resistance. But a breakdown back below 73.85 would do a good job of putting the longer-term downtrend back in play and accelerate declines, potentially exposing a retest of that 68.27 multi-year low, the lowest level since March of 2009. Dollar CAD. So dollar CAD continues to show signs of recovering off that recent low that we saw at 29.23, a 2016 low, with the market stalling just shy of the October base at 128.32. At this point, though, we would need to see a break back above 134.06 to really take the pressure off the downside and accelerate gains. Until then, there is still risk for a bearish reversal back down to retest that 28.32 October base. Kiwi dollar. So Kiwi continues to be very well capped on any rallies towards medium-term resistance at 69, with setbacks seen potentially towards next key support at 65.46. A break below 65.46 would then expose medium-term support at 63.47 further down. Ultimately, only a break back above 69 would really force a shift in this structure. SPX 500. So the S&P 500 is finally showing signs of wanting to top out following this impressive rally out from those February lows at 1808. At this point, there's risk for a reversal now, with the market seen breaking down and accelerating back below 2000, eventually back towards the recent multi-month low at 1808. An eventual break below 1808 would then expose the next major measured move downside extension towards the 1550 area. Only a weekly close back above 2050 would negate this newly adopted bearish outlook for the S&P 500. Gold. So despite this latest impressive round of setbacks in gold, the market continues to retain a constructive outlook overall and should be looking to put in a higher low somewhere above that previous resistance turn support at 1191 in favor of the next major upside extension towards the 2015 peak at 1307 further up. At this point, only a close back below 1191 would compromise the newly adopted bullish outlook for the gold market.